Hello, everyone, and welcome back to The Deep Dive. Hope you're having a fantastic week and are ready for another in-depth exploration into the heart of a truly fascinating business. Today, we're taking a deep dive into one of North America's most recognizable retailers, Home Depot, Inc. You know it. You've probably walked through its orange doors. It's traded on the New York Stock Exchange under the ticker HD. On the surface, it's the undisputed titan of home improvement, a business so ingrained in our communities it almost feels like, a public utility sometimes. But the real question, as we peel back the layers and navigate through the information we've gathered, is this. Are its competitive foundations as solid as the, say, building materials it sells? Or are there underlying vulnerabilities that maybe the market might be overlooking? That's exactly what we're here to unpack for you today.
That's a massive question indeed. And it really sets the stage for what promises to be a pretty insightful deep dive. And before we get into all the specifics, just a quick note for you, our dedicated listener.
Yeah, for those of you who want to act on these kinds of insights, having a professional-grade platform that empowers your own research and execution is, it's absolutely key. We found a great partner who can offer you a stock bonus when you sign up through our link, giving you a tangible head start.
So you get a bonus and support our deep dive at the same time. That link is right there in the description, isn't it?
That's right. It's all there for you. And of course, if you find value in this kind of in-depth discussion and the meticulous analysis we bring to the table, the very best way to let us know and to make sure you get the next one is to subscribe and like this video. It truly helps our deep dives reach more curious minds. And if you have any questions regarding the company as we go through this, please, share them with us. We love hearing your thoughts.
Excellent. Now let's get straight into it. We'll begin by building a foundational understanding of the Home Depot business model itself, delving into how this retail giant actually makes its money, and exploring the underlying durability of that model.
Okay, let's unpack this. On the surface, Home Depot seems straightforward. They sell home improvement stuff. Hammers, paint, lumber. But I imagine there's a lot more nuance once you peel back the layers. What's truly surprising about how Home Depot generates its revenue, beyond just selling, the basics.
You've hit on a crucial point. It seems simple, but the execution is incredibly sophisticated. Home Depot isn't just the world's largest home improvement retailer. They operate a truly advanced Omni-Channel model that spans all of North America. While product sales are, as you'd expect, their primary revenue driver, is how they drive those sales, and importantly, to whom, that reveals the deeper strategy. First, and most obviously, they sell an immense range of products. Everything from basic building materials like lumber and drywall to specialized home improvement items, a vast lawn and garden selection, and even home decor. But here's a critical distinction. These sales are fueled by two very different customer segments. You have your classic do-it-yourself, DIY consumers, people like you and me, maybe tackling weekend projects. And then crucially, you have professional contractors whom they simply call pros. These sales flow through both their physical stores, over 2,300 of them, and their robust, deeply integrated e-commerce platform. It's not just a website, it's a seamless experience where your in-store and online interactions are completely intertwined.
Okay, so it's more than just walking in the store.
Exactly. And beyond just products, Home Depot strategically offers a suite of services that are designed to capture a larger share of your home improvement spending, and importantly, these tend to be higher margin offerings. Think about their Do-It-For-Me, DIFM, installation services. This is where Home Depot coordinates the entire installation for big-ticket items like flooring, custom cabinetry, or even that new water heater you desperately need. They also run a very successful tool and equipment rental business, which caters to both DIYers who need specialized gear for a temporary project, and again, the pros who might need a specific, expensive piece of machinery for a job.
Right, renting that big tiller you only need once a year or something.
Precisely. Now, let's talk about the professional customers, pros. This segment is not just important, it's critical and incredibly lucrative for Home Depot. These are your remodelers, general contractors, electricians, plumbers, the folks who are making significantly larger and far more frequent purchases compared to the average DIY consumer. In fact, this segment alone accounts for roughly half of Home Depot's total revenue.
Half? Wow, that's huge.
It's massive. And a key differentiator from rivals. To keep these pros coming back, Home Depot has built a comprehensive, dedicated ecosystem. This includes their Pro Extra loyalty program, which offers bulk pricing and exclusive deals, dedicated in-store support desks staffed by knowledgeable associates, and specialized delivery options that bring materials directly to the job site. It's a full-service approach.
So they're really catering to that specific group.
Very much so. Finally, they boost their profitability and differentiate their offerings through their private label brands. These are exclusive brands you can only find at Home Depot, like Husky Tools, Glacier Bay for kitchen and bath fixtures, or Hampton Bay for lighting and fans. These brands generally carry higher profit margins than third-party products and help build customer loyalty because, again, you can't get them anywhere else. So it's not just about selling. It's about a diversified, deeply integrated approach to the entire home improvement life cycle.
That's a much more layered picture than just a typical retail store. It truly sounds like a one-stop shop for everything related to home improvement. But this leads me to a fundamental question. How durable is this model? Will Home Depot remain relevant and dominant in the coming decades, especially with all the talk about e-commerce changing everything? Or is there, a ticking clock on this kind of retail giant?
That's an excellent point, and it gets to the heart of what makes Home Depot such a compelling business for the long term. The fundamental model is, as you observed, exceptionally simple and highly intelligible. They essentially provide the essential picks and shovels for a very basic and enduring human need: shelter and the inherent desire to improve one's living environment. This isn't a fad or a niche market. It's a timeless aspect of human existence. Because of this foundational need, this model is highly likely to remain incredibly relevant and dominant for at least the next 1 to 2 decades.
Okay, so the basic need isn't going away.
Right. And you see several powerful, durable structural trends in the North American housing market that underpin this endurance. For instance, the median age of a U.S. home now comfortably exceeds 40 years, and that number continues to climb. Older homes naturally require more frequent repair, maintenance, and renovation. Think new roofs, updated plumbing, general wear and tear. This creates a perpetual and growing source of demand for Home Depot's products and services. Compounding this, we have a persistent structural shortage of housing inventory across the U.S. The supply-demand imbalance makes it difficult or undesirable for many people to move, which in turn strongly encourages them to invest more in improving their current homes rather than buying new ones.
The fixer-upper trend, driven by necessity.
Exactly. Beyond these structural trends, there's the immutable aspect of human behavior we just touched upon. The desire to maintain and enhance one's home is a timeless aspiration. This demand is driven by both necessity, a burst pipe, a leaking roof, and aspiration, like that dream kitchen remodel you've always wanted. While the intensity of discretionary spending on home improvement can be cyclical and sensitive to broader macroeconomic factors like interest rates and consumer confidence, the underlying non-discretionary need for repairs is constant. We saw a powerful illustration of this during the COVID-19 pandemic. People, spending unprecedented amounts of time at home, reallocated their discretionary funds toward home improvement projects, leading to a massive surge in DIY activity that really proved the resilience of the category.
Yeah, everyone suddenly became a home improvement expert, or tried to be.
Right. And a critical element of this model's endurance, especially in the age of widespread e-commerce, is the deep integration of Home Depot's physical and digital assets, their omni-channel strategy. This isn't just about having a website. It's a fully integrated system where their physical stores, all 300 plus of them, function as indispensable logistical hubs. By offering services like buy online, pick up in store, both eyes, and buy online, deliver from store, BUDFS, Home Depot effectively leverages its vast real estate footprint as a network of forward-deployed distribution centers. Imagine a professional contractor who needs a specific odd-sized valve to finish a plumbing job right now. They can't afford to wait for 2 days shipping. The ability to acquire it from a local Home Depot within the hour is an incredibly powerful competitive advantage that a pure-play e-commerce competitor simply cannot replicate for heavy, bulky, or time-sensitive products. So rather than diminishing the relevance of their stores, the rise of e-commerce has actually enhanced their strategic importance as crucial last-mile fulfillment centers, making them more valuable than ever.
That's a huge aha moment right there. Thinking of the stores as these strategic logistical weapons. That makes perfect sense. Now, you mentioned a wide economic moat earlier, suggesting a durable competitive advantage. Could you elaborate on what exactly constitutes this fortress for Home Depot beyond just being a big retailer?
Absolutely. When we talk about a wide economic moat, we're referring to a durable competitive advantage that should allow Home Depot to earn excess returns on capital for many decades to come. This isn't just about being a good business. It's about having structural advantages that protect those profits from competitors. For Home Depot, this moat isn't derived from a single source, but rather from what Charlie Munger called a Lollapalooza effect, a powerful composite of factors that multiply each other's strength. The primary components are significant cost advantages stemming from their immense scale and powerful intangible assets, particularly in the form of one of retail's most iconic brands.
Okay, let's break that down. What does being the world's largest actually mean for their competitive edge in terms of costs? How does that translate into a real advantage that smaller competitors simply can't touch?
It's a formidable weapon, to put it simply. With fiscal 2024 sales approaching a staggering $160 billion, Home Depot's sheer size gives them immense bargaining power over the thousands of suppliers they work with. Think about it. They're buying materials, tools, and products in quantities no one else can match. This allows them to negotiate superior pricing and more favorable terms, things like extended payment windows or exclusive product lines that smaller rivals could never hope to obtain. This cost advantage directly translates into their ability to offer competitive, everyday low prices to you, the customer, while simultaneously maintaining industry-leading profitability for themselves. Furthermore, this massive scale enables them to make huge, efficient, and almost continuous investments in their supply chain, in cutting-edge technology like their One Home Depot interconnected retail strategy, and in marketing. These investments continually widen the gap between Home Depot and its smaller competitors, creating a self-reinforcing cycle of dominance.
So scale begets more scale, essentially.
In a way, yes, and beyond cost, their brand is an equally powerful, intangible asset. The Home Depot brand, with its iconic orange logo, is synonymous with home improvement across North America. This top-of-mind awareness has been cultivated over more than 4 decades through consistent marketing, pervasive store presence, and years of customer trust. This brand equity significantly reduces your search costs as a customer. You don't have to think hard about where to go for a home project. Home Depot is often the default starting point. That's a massive advantage in a fragmented market, saving customers time and decision fatigue.
That sounds incredibly strong in theory, but theory can be different from practice. Can you give us a tangible, real-world example of how these moat sources, the cost advantage, the brand, the entire ecosystem combine to actually repel competitors on a daily basis? How does this fortress operate on the ground?
Okay, let's imagine a professional remodeling contractor. This isn't a simple trip for a single item. They're embarking on a full bathroom renovation. They need a diverse range of materials, job lot quantities of drywall and tile, specific plumbing fixtures, a vanity, and maybe a high-end power tool from a trusted brand like Milwaukee.
Right, a typical big project.
Exactly. The cost advantage is immediately apparent here. Home Depot's scale allows it to offer competitive bulk pricing on that drywall and tile that a local independent hardware store simply cannot match. For a professional, those small savings across large quantities add up significantly over a year of projects. Then, the brand and ecosystem create a frictionless, integrated experience that saves the contractor invaluable time and hassle. The contractor trusts that Home Depot will have these necessary, often specialized items in stock. Using the Home Depot mobile app, they can verify inventory at the nearest store, place the order online for in-store pickup, and have all materials staged and ready upon arrival, saving hours of valuable time they would otherwise spend searching aisles. For even larger or more complex orders, they can leverage Home Depot's sophisticated delivery network, which, especially after recent acquisitions we'll discuss, can now handle complex job site deliveries with greater efficiency and precision.
So speed and convenience become part of the moat, too.
Absolutely critical for the pro. This seamless integration of competitive price, vast selection, and omni-channel convenience actively repels competitors. An online-only retailer cannot fulfill the immediate need for bulky, heavy materials or provide the on-site expertise if a contractor has a question. A smaller physical competitor simply lacks the purchasing power on commodity items and the sophisticated digital tools that Home Depot offers. This everyday transaction, happening thousands of times a day across their stores, is a microcosm of the moat in action, creating a sticky, high-value relationship that is incredibly difficult for any rival to disrupt. It's not just about one transaction, it's about Home Depot becoming an indispensable partner for these pros.
That's a vivid picture of how the moat works in practice. So it's not just a stable moat. The information suggests it's actually getting stronger, that its trajectory is widening. How is Home Depot actively achieving that, and what are the key drivers of this expansion?
Yes, the evidence strongly points to an actively widening economic moat, and the primary driver of this expansion is the company's aggressive and strategic deepening of its capabilities, specifically to serve the pro customer. This is a real game changer. The recent multi-billion-dollar acquisitions of SRS Distribution for, what was it, $18.25 billion and GMS for $5.5 billion are truly transformative moves, signaling a monumental shift. These aren't just ancillary additions to their existing business, they are foundational investments aimed at dominating the complex project needs of professionals, especially in specialized trades like roofing, landscaping, and even pool contracting.
Wow, those are huge bets.
Huge. By integrating these leading specialty trade distributors, Home Depot is significantly expanding its total addressable market, or TAM, meaning the total size of the opportunity they can go after. Crucially, it's creating an even more comprehensive pro ecosystem. This ecosystem aims to be the single source provider for an entire project, offering not just the materials you'd typically find in a Home Depot store, but also specialized fulfillment tailored for specific trades, vital trade credit to manage cash flow on big projects, and a dedicated sales force that truly understands the unique needs of these professional trades. This strategy dramatically increases the switching costs for their most valuable customer segment. Once a pro is deeply embedded in this ecosystem, leveraging its credit, specialized delivery, and account management, it becomes incredibly difficult and costly for them to switch to a competitor for marginal savings. These investments are already bearing fruit, having contributed over $1 billion in incremental sales. This strategic focus on building an insurmountable platform for the pro is a clear indication of a widening competitive fortress.
That strategic emphasis on the pro customer makes a lot of sense, and this business quality, especially that Lollapalooza effect, reminds me of some powerful frameworks that great investors often use. What mental models help us truly understand Home Depot's enduring strengths?
That's a great connection to make, because Home Depot's market dominance is a quintessential example of what Charlie Munger termed the Lollapalooza effect. This is where a confluence of multiple factors acts in concert to produce a nonlinear, overwhelmingly powerful outcome that is far greater than the sum of its individual parts. For Home Depot, these forces include its massive scale economies, which provide unmatched purchasing power and logistical efficiency. Then there's its iconic and trusted brand recognition built over decades. You also have customer habit. The one-stop shop convenience makes it the default choice for so many, reinforcing customer behavior. And finally, the self-reinforcing pro ecosystem we just discussed. As more professionals use the platform, Home Depot can invest even more in tailored services like specialized credit and delivery, which in turn attracts even more pros, creating a virtuous cycle that just keeps getting stronger. These factors don't just add to each other, they multiply and interlock, truly creating a competitive fortress.
So it's like multiple advantages feeding off each other.
Exactly. Another crucial mental model at play here is the circle of competence, championed by both Warren Buffett and Charlie Munger. Home Depot's management has demonstrated a very clear and disciplined adherence to its core expertise, the North American home improvement market. It's interesting to look at their history. Their failed expansion into China served as a powerful, albeit costly, lesson in the perils of venturing outside this circle. The current strategy, particularly with the SRS and GMS acquisitions, reflects that lesson perfectly. These are not diversifications into unrelated fields. They represent a strategic deepening of the company's dominance within its established circle of competence. This is an intelligent expansion of capability within their area of expertise, which is a hallmark of rational, long-term strategic thinking, distinguishing them from companies that chase fads or stray too far from what they truly understand.
Sticking to their knitting, but making the knitting much stronger.
That's a good way to put it.
Okay, those mental models definitely illuminate the underlying strength. But let's shift to something a bit more granular, almost like on-the-ground intelligence. Scuttlebutt. When we dig into customer sentiment, we find a curious paradox. There's a lot of love, but also some serious criticism. What's the story here? Does everyone love Home Depot, or is it a tale of two very different experiences?
It is indeed more complicated than a simple yes or no, truly a tale of two very different customer experiences. On one hand, online review aggregators paint a concerning picture. For example, you see ratings as low as 1.7 out of 5 on Reviews.io, and the Better Business Bureau has logged over 12,000 complaints in just the last 3 years. The recurring themes in these negative reviews are severe problems with the delivery and installation of complex, big-ticket items like appliances and cabinetry, often coupled with frustrating and unresponsive customer service when customers try to resolve these issues. It sounds like a real pain point, especially for anyone who's ever dealt with a large home project.
Yeah, delivery horror stories are pretty common online for big items.
They are. However, on the other hand, if you look at broader survey data, it suggests a much healthier customer relationship. Home Depot maintains a positive Net Promoter Score, or NPS, of plus 21, which is respectable. And perhaps even more tellingly, they have a remarkably high customer loyalty score, with 82% of users identifying as loyal customers.
So how do you square that? Terrible reviews, but high loyalty.
This significant discrepancy highlights a critical distinction. The negativity appears to be heavily concentrated in what we call the do-it-for-me service layer. This involves complex logistics, often multi-step interactions, and coordination with third-party contractors. The potential for failure in these high-touch multi-party processes is exponentially higher than in a simple retail transaction where you walk in, pick up an item, and leave. In contrast, the core retail experience, the ability to walk into a store, find what you need quickly, and purchase it, is largely tolerated, if not universally loved, because of the powerful gravitational pull of Home Depot's moat. The convenience, the competitive pricing, and the sheer selection.
So the basic shopping part works, but the complex service part is where they stumble sometimes.
That seems to be the pattern. So while that powerful moat ensures customers return for core products, the friction and brand damage caused by poor execution in that service layer is a significant long-term vulnerability. Home Depot's stated goal is to provide unparalleled service at every touch point, but that's clearly not being met in this particular segment. You could even argue that a competitor like Ace Hardware, with its focused handyman services, could potentially exploit this weakness and begin to chip away at Home Depot's brand equity if these service issues persist.
That's a fascinating and important distinction. So what about the people behind the Orange Apron? What does employee sentiment reveal about the culture and the health of the workforce? Is that a strength or a potential area of concern for the business?
Employee sentiment is similarly mixed, much like the customer experience. On platforms like Indeed, Home Depot holds a respectable overall rating of 3.7 out of 5, based on nearly 70,000 reviews. Positive themes frequently cited by employees include good benefits for a retail job, opportunities to learn new skills, and a strong sense of camaraderie with their coworkers. That paints a picture of a generally positive work environment.
Okay, 3.7 isn't bad for retail.
Not bad at all. However, there are also persistent and concerning criticisms. These often revolve around the inconsistency of hours for part-time staff, which can be a major issue for those relying on the income. There are also mentions of variable quality of store-level management, which can lead to pockets of low morale. For a company whose original value proposition was built on having highly knowledgeable, expert associates, often former tradespeople themselves, on the sales floor, these trends are a potential threat to a key differentiator. An engaged, knowledgeable, and helpful workforce is a crucial, if intangible, component of Home Depot's moat, especially as a defense against impersonal online competitors. If associates are disengaged or spread too thin, this advantage erodes, the customer experience suffers, and the brand's reputation as the product authority is weakened. It's a risk they're clearly aware of, and it's a positive signal that management recently invested approximately $1 billion in incremental annualized compensation for its frontline associates, indicating they recognize and are actively attempting to address this risk.
Good that they're putting money towards it, at least.
Exactly. So with that detailed understanding of Home Depot's business model, its moat, and internal dynamics, let's cast our gaze outward and examine the competitive landscape. Home Depot operates in what's effectively a duopolistic market structure, meaning they have one primary direct competitor and then several smaller, more specialized rivals.
Okay, so who are these direct competitors, and how does Home Depot really stack up against them? Are they truly playing in different leagues?
You've got it. The undisputed number 2 is Lowe's companies, ticker LOW. They operate a business model that is nearly identical to Home Depot's, essentially mirror image, but they are significantly smaller, with revenues roughly half those of Home Depot. Lowe's is actively attempting to emulate Home Depot's successful strategy of catering to the pro customer, even being led by a CEO who is a former Home Depot executive. Despite these efforts, Lowe's remains significantly behind in this crucial segment, with pros accounting for an estimated 30% of its sales versus Home Depot's impressive 50%. While Lowe's is often perceived as having a brighter, perhaps more aesthetically appealing store layout for the DIY customer, Home Depot maintains the lead in terms of sheer scale and deeply embedded pro focus.
30% versus 50% for pros, that's a big difference.
It's a huge gap. Then you have players like Ace Hardware. They are a smaller competitor with a differentiated co-op business model. Their most notable strategic distinction is a focus on providing in-home handyman services, which directly targets that execution weakness we identified earlier in Home Depot's Do-It-For-Me offering. They're trying to capitalize on that service gap.
Trying to exploit that vulnerability we talked about.
Precisely. And of course, we can't forget Amazon, AMZN, and other online retailers. These players represent a competitive threat for smaller, easily shippable packaged goods that don't require immediate expertise or bulk. Think nuts, bolts, small hand tools. However, they are structurally disadvantaged in the core home improvement categories. They struggle immensely with the challenging logistics of heavy, bulky items like lumber or appliances, and they simply cannot provide the immediate product availability or the in-person expertise that many complex home improvement projects require. For instance, Amazon can ship you a new drill, but it can't offer advice on which type of plumbing pipe to use for a specific repair or cut a sheet of plywood to size for you on the spot.
Right. You can't easily ship a pallet of drywall.
Not easily, and certainly not quickly or cheaply. Ultimately, Home Depot's key, durable advantage in this landscape is its self-reinforcing ecosystem built specifically for the professional customer, powered by its unmatched scale. While Lowe's is certainly pursuing a similar strategy, they are playing a persistent game of catch-up against a larger, more focused, and more aggressive competitor. The strategic acquisitions of SRS and GMS have materially widened Home Depot's lead in serving the complex needs of the pro, creating an end-to-end platform that Lowe's will find exceedingly difficult and capital-intensive to replicate. It's not just about spending money. It's about building expertise and relationships that take decades to forge.
Okay, so let's put some numbers on that. How do they compare head-to-head?
To give you a snapshot, let's look at some key comparisons. Home Depot's trailing 12-month revenue stands at around $163 billion, which is nearly double Lowe's approximately $83 billion. That's an enormous scale advantage. Their market capitalization further reinforces this, with Home Depot at around $372 billion compared to Lowe's at $127 billion. In terms of physical footprint, Home Depot has roughly 2,347 stores, a larger network than Lowe's 1,973. And as we discussed, the revenue from pros is 50% for Home Depot versus just 30% for Lowe's, underscoring Home Depot's stronger, more lucrative pro focus. When it comes to profitability, Home Depot consistently shows a higher 10-year average operating margin, meaning they're more efficient at turning sales into profit. Interestingly, from a valuation perspective, Lowe's currently trades at a slightly lower valuation, with a trailing 12-month PE ratio of about 19.1x compared to Home Depot's 25.6x. This disparity in valuation reflects the market's perception of Home Depot's superior quality and stronger growth prospects.
So bigger, more pro-focused, more profitable, but also more expensive stock-wise.
That's the trade-off, generally. Okay, having established that Home Depot is a high-quality business with a widening moat, our analysis now shifts to the stewards of that fortress, the management team. A wonderful business can be compromised by inept leadership or irrational capital allocation. This section assesses whether the leadership team exhibits the long-term, owner-oriented mindset necessary to preserve and enhance shareholder value over decades.
Right. Let's start with the leadership itself. What is the CEO's overarching philosophy, and how does that permeate and influence the strategic direction of Home Depot? Does it feel like a truly cohesive vision?
The leadership team, currently under CEO Ted Decker, articulates a very clear and consistent operating philosophy in all their public communications, from annual reports to proxy statements. This philosophy centers on a handful of core strategic priorities. Delivering the best interconnected customer experience, which we've already seen is a complex task. Developing differentiated capabilities with a very strong emphasis on that pro-customer segment. Extending the company's position as a low-cost provider, and ultimately growing market share to deliver exceptional shareholder value. This strategy is deeply rooted in the company's foundational inverted pyramid culture, a legacy from its very founders. What that means in practice is that they prioritize the needs of customers and frontline associates above all else, seeing them as the true drivers of value. The belief is that taking care of your employees leads to superior customer service, which in turn drives strong, sustainable business results. Crucially, their strategic planning is explicitly long-term, with multi-year investment roadmaps and financial targets regularly shared with the investment community, indicating a focus beyond just the next quarter. They're playing the long game.
That emphasis on long-term thinking is certainly a hallmark of disciplined management. But how do their personal incentives align with those of long-term shareholders? Are they truly playing with skin in the game, or are their bonuses tied to more short-term metrics that might not serve the long-term investor?
The alignment between management and shareholders is structurally reinforced through both the executive compensation program and significant insider ownership. When you look at their compensation structure, it's heavily weighted toward long-term, performance-based incentives. For example, their 2025 proxy statement details that a significant portion of executive pay is contingent upon achieving multi-year performance goals. And these goals are critically tied to key drivers of long-term value creation, such as average return on invested capital, or ROIC, and average operating profit. This structure ensures that executives are rewarded for improving the fundamental economic engine of the business, not just for short-term stock price fluctuations.
So they get paid based on how well the actual business does over time.
Exactly. Furthermore, the leadership team truly has substantial skin in the game. The CEO and other named executive officers hold significant stock ownership. The company also enforces strict stock ownership guidelines that require executives to hold a multiple of their base salary in company stock. This direct financial stake powerfully aligns their interests with those of long-term shareholders. They literally prosper only as the shareholders do. A very robust alignment mechanism, giving you confidence that their interests are tied to yours.
That sounds like a very disciplined and shareholder-friendly approach. How does this philosophy and incentive structure translate into their actual capital allocation track record? Where does their vast amount of cash go, and what are their priorities?
Management's approach to capital allocation is truly a model of discipline and clarity. They consistently communicate and adhere to a three-tiered framework that prioritizes long-term business strength above all else. Their first and highest priority is to reinvest in the business. They typically target around 2% of annual net sales for capital expenditures for ongoing improvements and maintenance. More importantly, as we've discussed, they've shown a strong willingness to make bold, strategic investments, specifically to widen that competitive moat. The multi-billion-dollar acquisitions of SRS Distribution and GMS are powerful, very recent examples of this principle in action. They are clearly willing to spend significant capital when it means strengthening the core business for the long term.
Okay, so reinvest first. What's next?
Their second priority, after meeting the needs of the business, is to pay a growing dividend. Home Depot has an impressive track record, having paid a dividend for over 150 consecutive quarters. That's nearly 40 years, which is a testament to their financial resilience and their commitment to shareholder returns. In fiscal 2024, they returned a substantial $8.9 billion to shareholders through dividends alone.
Wow, almost 40 years of dividends. That's consistency.
It really is. And finally, their third priority is to return excess cash via share repurchases. This means only after fully funding internal investments that will strengthen the business, and after paying their reliable dividend, do they return any remaining excess cash to shareholders through buybacks. It's a very clear, logical hierarchy.
Based on that, it sounds like their capital allocation is not just rational, but remarkably transparent and consistent. What's your overall assessment of their capital stewardship and their decision-making process?
The evidence overwhelmingly points to a rational, disciplined, and highly shareholder-friendly capital allocation strategy. Management has a clear framework, communicates it transparently, and executes it with remarkable consistency. A prime example of this rationality was their decision to pause their share repurchase program in March 2024, specifically to help finance the strategic acquisition of SRS. This action powerfully demonstrates a clear prioritization of strengthening the long-term competitive position of the business over any short-term cosmetic benefit of simply supporting the stock price. Looking at the bigger picture, over the past 5 years, the company has returned a massive $73 billion to shareholders through dividends and share buybacks, demonstrating a powerful commitment to returning capital when it is not needed for strategic reinvestment.
So they're willing to pause buybacks for a big strategic move? That speaks volumes.
It does. If you look at the capital allocation summary, you can see this trend clearly. In fiscal 2024, there's a significant jump in cash for acquisitions, reaching $17.6 billion, directly reflecting that SRS deal. This contrasts sharply with previous years, where acquisition cash was minimal or zero, and share repurchases were much higher, like $14.5 billion in 2022. It truly shows a management team willing to make the tough but strategically sound long-term decisions that will benefit the company for years to come.
Okay, so solid management. Now, beyond their stewardship, let's assess the company's financial resilience. How strong is Home Depot's financial fortress from a purely numbers perspective?
Right. What does the raw financial performance tell us about the health and quality of this enterprise? How consistent has their profitability been, especially given the cyclical nature of the housing market?
Yeah, has it been up and down a lot?
Home Depot has demonstrated truly remarkable and consistent profitability for over a decade. Looking at their financial performance, you see steady growth in revenue and earnings prior to the COVID-19 pandemic. Then there was a significant boom during that pandemic-fueled home improvement surge, and what's impressive is the subsequent normalization that has left them operating at a much higher plateau than before. Even in the face of recent macroeconomic headwinds, such as higher interest rates impacting housing, the business remains a formidable cash-generating machine, producing a net income of $14.8 billion in fiscal 2024. That kind of consistent performance, even through economic shifts, is a strong indicator of underlying business quality.
So they benefited from the pandemic boom, but kept a lot of those gains.
Exactly, a higher baseline. Beyond those top-line numbers, what do the underlying financial quality ratios tell us about the intrinsic health of this business? Are they just growing, or are they growing efficiently and sustainably?
Right. Let's look under the hood.
A review of key financial ratios certainly underscores the high quality of the enterprise. Let's start with return on invested capital, or ROIC. This is a critical metric for any investor, telling you how efficiently a company uses the capital invested in it to generate profits. Home Depot consistently generates exceptionally high returns on the capital it employs, which is a key indicator of a superior business. The adjusted ROIC for fiscal 2024 was an impressive 31.9%. Historical data reveals that the company's ROIC has frequently surpassed 30% and even 40%, placing it in an elite category of businesses.
Over 30-40% ROIC. Wow, that's incredibly high.
It is. To put that in perspective, for every dollar they've invested, they're generating 30-40 cents back annually. Now, a nuance to note here is that the company's aggressive share repurchase programs have systematically reduced the equity component of its invested capital base. Mathematically, this can inflate the ROIC calculation. However, even with that caveat, the underlying profitability that drives such high returns is undeniable, so it's a very strong metric for them.
Okay, so high returns. What else?
Next, free cash flow, or FCF, conversion. This tells you how well a company converts its accounting profits into actual spendable cash. A high FCF conversion rate indicates high-quality earnings and robust financial health. Home Depot's FCF conversion has consistently been superb, often exceeding 100%. For instance, it was 110.3% in fiscal year 2025 and 118.5% in fiscal year 2024. This means that for every dollar of net income they report, they generate more than $1 of discretionary cash flow, providing ample resources for both reinvestment into the business and returns to shareholders. This is a sign of incredibly healthy cash-generating operations.
Generating more cash than profit? That sounds like a good problem to have.
It's a sign of very high-quality earnings. Finally, let's look at their balance sheet strength. It remains strong, even after taking on significant debt to finance the SRS acquisition, which pushed their total debt above $50 billion. This strategic leverage appears prudent and highly manageable, primarily because the company's immense and consistent cash generation provides robust coverage for its obligations. As of the latest reporting, their debt is well covered by operating cash flow, and their interest coverage ratio is a very healthy 9.5x. This indicates a low risk of financial distress, which is crucial for a business of this scale making such large strategic moves.
So even with the big acquisition debt, they can handle it.
Comfortably, it seems. Looking at the 10-year history of their financial quality ratios, you consistently see those high ROIC figures, often above 30%, which is truly exceptional. Their FCF conversion rates are frequently above 100%, highlighting that strong cash generation. And despite the significant debt taken on for the SRS acquisition, their net debt to EBITDA ratios have historically been very manageable, consistently below 2x, only rising above that after a major acquisition. This overall picture reinforces the qualitative view of a financially robust enterprise.
Okay, so great business, widening moat, solid management, strong financials. Sounds pretty good.
It does. But now that we've deeply analyzed the business quality, management stewardship, and financial resilience of Home Depot, we arrive at a critical juncture: valuation, risks, and catalysts. Because, as we always emphasize, a wonderful company purchased at a terrible price will not yield a wonderful investment return.
That's the ultimate hurdle, isn't it? We've established this as a high-quality business, but what does the market currently think of Home Depot's value? Is it priced as the fortress we've described, or is there a disconnect?
Indeed, Home Depot has consistently commanded a premium valuation from the market. This is a clear reflection of its widely recognized business quality, its wide economic moat, and its consistent financial performance. The market's reasoning for this premium is sound. It's justified by the company's dominant market share, those superior profitability metrics like ROIC we just discussed, and its long history of shareholder-friendly capital allocation.
So the market knows it's good.
It definitely knows. However, an analysis of the company's historical price-to-earnings, or PE ratio, reveals that the market rarely, if ever, offers this business at a statistically cheap price. Over the past decade, Home Depot's trailing 12-month PE ratio has generally fluctuated within a range of approximately 16x to 27x. The current PE ratio, sitting at around 25x, places the stock at the higher end of this historical valuation range. This indicates that a significant degree of optimism about its future prospects is already priced in. For example, looking at the historical valuation profile, the PE ratio hit 27.29x in fiscal 2025, while it dipped to a low of 16.08x in 2019. This demonstrates that while quality commands a premium, there's a meaningful range within which the market values this company, and we're currently at the pricier end.
25 times earnings.
Yeah.
It's not exactly cheap territory.
Not typically. Applying the mental model of margin of safety to a high-quality, predictable business like Home Depot requires a nuanced approach. It doesn't mean waiting for a deep value multiple of, say, 8x earnings, because that's frankly unlikely to ever materialize absent a catastrophic business-altering event. Instead, a margin of safety for a company like Home Depot means purchasing its shares at a price that provides a high probability of a satisfactory long-term return, offering protection against both unforeseen operational stumbles and the inherent risk of overpayment.
So it's about paying a reasonable price, not necessarily a cheap price.
Exactly. The conditions that would likely create such an opportunity, allowing for that margin of safety, typically fall into two categories. First, a market-wide panic. This would be a severe bear market or a deep recession that causes an indiscriminate sell-off of all equities, dragging even high-quality companies like Home Depot down with the rest of the market. This is rare, but provides excellent opportunities for disciplined investors.
The classic buy when there's blood in the streets scenario.
Right. The second, and arguably more probable scenario, is a company-specific but temporary setback. For example, we've observed recently a period of several quarters of disappointing results driven by a cyclical housing slowdown. If the market overreacts to this kind of temporary weakness and extrapolates it into a permanent decline in the company's long-term prospects, it would create a disconnect between the short-term stock price and the underlying long-term intrinsic value of the business. An investment made during such a period of excessive pessimism would offer an attractive margin of safety, provided your analysis confirms that the long-term competitive moat remains firmly intact.
So you're looking for the market to overreact to short-term noise.
That's often where the opportunity lies with high-quality names. That truly illustrates that the price you pay is the ultimate determinant of your future return, even for a fantastic business. It's not enough to just pick a great company.
Yeah, the entry point matters. A lot.
Precisely. An investment in Home Depot serves as an excellent case study for this principle. Consider an investor who acquired shares at the lower end of its historical valuation range, say around 16 to 18x PE. That investor would have benefited from two powerful return streams: the company's underlying earnings growth and the potential for that valuation multiple to expand back toward its historical average. Conversely, an investor purchasing shares today near the high end of that range at approximately 25 back PE is relying almost exclusively on future earnings growth to generate their return. This investor faces the additional risk of multiple contraction. What that means is, even if the business continues to perform well, if market sentiment shifts and investors decide they're not willing to pay as high a multiple for those earnings anymore, the PE ratio could revert to its mean. This could potentially lead to mediocre or even negative returns for a period of years, even if the underlying business itself continues to perform well. It highlights the crucial distinction between a great business and a great investment opportunity. It's like buying a fantastic car at the peak of a craze. Even if the car itself runs perfectly, you might end up losing money if people stop paying such a premium for it.
So buying high means you need everything to go right just to break even or make a decent return.
Pretty much. You're banking entirely on future growth with no valuation tailwind. Okay, so Home Depot has this incredible foundation, but valuation is key. What is the single most important engine for Home Depot's future earnings growth over the next 5 to 10 years? And applying the mental model of inversion, what are the most critical long-term risks that could permanently damage this business? What could go catastrophically wrong, truly, fundamentally wrong?
Yeah, let's flip it. What keeps Home Depot execs up at night?
The single most important identifiable driver for Home Depot's future earnings growth is the continued expansion and monetization of its pro-customer ecosystem. The success of this strategy, specifically, the effective integration of the massive SRS and GMS acquisitions, their ability to capture a greater share of the pros' total project spend, and the leveraging of new capabilities like trade credit and specialized fulfillment will be the primary determinant of the company's growth trajectory over the next 5 to 10 years. If they nail this integration and expansion, that's where the significant growth will come from. Now, applying the mental model of inversion, considering what could go catastrophically wrong, thinking in reverse, helps to identify the most critical long-term risks that could permanently damage this business. First, a protracted housing depression. While Home Depot's business is remarkably resilient to normal economic cycles, a deep, prolonged, and structural decline in the U.S. housing market could permanently impair its earnings power. This isn't just a cyclical slowdown caused by interest rates. It refers to a more fundamental negative shift, perhaps driven by adverse demographic trends or a truly long-lasting economic depression. That would hit them hard at their core.
A real estate collapse, basically.
The severe, long-lasting one, yes. Second, and arguably the most significant internal risk, is a brand and service reputation collapse. This refers to a continued failure to resolve the widespread execution issues we discussed in the do-it-for-me and complex delivery service layers. If these problems persist and are not fundamentally fixed, it could lead to a severe erosion of brand trust. If the Home Depot brand loses its reputation for reliability and authority, that sense of being the reliable default choice, that wide moat we've discussed would narrow significantly, potentially permanently.
If people stop trusting the orange box.
Exactly. And third, competitive missteps and integration failure. The competitive landscape is not static. A failure to successfully integrate the massive SRS and GMS acquisitions could lead to operational chaos, culture clashes, and a failure to realize those promised synergies. This is a huge undertaking. Simultaneously, if Lowe's, their primary competitor, proves unexpectedly successful in its renewed efforts to catch up in the pro segment, Home Depot's primary growth engine could sputter, eroding its future growth prospects. These are the deep structural threats that could truly impair the business long-term.
Okay, those are some serious potential pitfalls. Beyond that long-term growth engine and those permanent risks, what are some potential catalysts that could unlock or accelerate value in the next 1 to 5 years? What could surprise the market to the upside in the near to medium term?
Several potential catalysts could certainly accelerate value creation. The first is successful SRS integration and pro ecosystem acceleration over the next 1 to 3 years. The market is very closely monitoring the integration of SRS, and frankly, it's a massive deal. If Home Depot can provide clear, quantifiable evidence that this acquisition is leading to accelerated, high-margin growth in the pro segment, demonstrated through successful cross-selling, higher wallet share, and the successful rollout of new services like trade credit, it could cause the market to re-rate the company's long-term growth prospects higher, leading to increased investor confidence and a potential multiple expansion.
So, proving that the big bet on SRS is paying off.
Exactly. Showing the synergies aren't just talk. The second key catalyst is an easing macroeconomic environment over the next 1 to 2 years. A significant decline in mortgage rates and a corresponding stabilization or recovery in the broader housing market could unlock substantial pent-up demand. Both DIY and pro customers have deferred many large-scale renovation projects due to the current economic uncertainty, high interest rates, and inflation concerns. An improvement in these conditions could lead to a period of above-average growth that potentially surprises a market currently focused primarily on the cyclical slowdown. That positive surprise could certainly move the stock.
So lower rates could unleash a wave of delayed projects.
That's the hope for many cyclical businesses right now. Okay, let's engage in a bit of second-level thinking here. When we consider Home Depot, what's the prevailing market narrative, the first-level thinking that most people would have?
What's the simple story everyone tells?
The prevailing market narrative, that first-level thinking, is quite clear. It generally goes something like this. Home Depot is a great wide moat company, but it's currently facing cyclical headwinds from a weak housing market and high interest rates. Growth has clearly slowed, and the stock is trading at a premium valuation. Therefore, it's probably a hold until the macroeconomic picture improves. It's a very common and seemingly logical conclusion, focusing heavily on the immediate economic climate.
Okay, seems reasonable. So how does a deeper second-level analysis challenge or differentiate itself from that consensus view? What are we missing if we stop at first-level thinking, and how can we gain an edge?
A deeper second-level analysis suggests that the market may be focusing too heavily on those short-term cyclical challenges while significantly underappreciating the long-term structural enhancements that are happening to the company's competitive moat. The consensus view correctly identifies Home Depot's quality, but it arguably misjudges the true trajectory and durability of its primary advantage. First-level thinking, for example, views the multi-billion-dollar acquisitions of SRS and GMS purely through a near-term financial lens. It assesses their immediate accretion to earnings per share and the impact of the increased debt on the balance sheet. This thinking sees a large retailer simply getting bigger.
Just adding more stores, more revenue.
Right. Second-level thinking, however, asks you a fundamentally different question. How do these acquisitions fundamentally alter the long-term competitive dynamics of the industry itself? By acquiring these specialized distributors, Home Depot is not just adding revenue, it's transforming its relationship with its most valuable customer. It's evolving from being merely a transactional supplier of goods into an integrated, indispensable partner for complex professional projects. This creates immense and durable switching costs. Think about it. A professional roofer who comes to rely on the combined Home Depot SRS ecosystem for materials, for specialized job site delivery, and critically for trade credit is far less likely to defect to a competitor for a marginal price difference on a single product. The hassle and cost of switching that entire integrated system become prohibitively high.
They become completely embedded in the Home Depot system.
That's the goal. Therefore, the contrarian second-level view is that the market is currently underestimating the true moat-widening power of this aggressive pro-ecosystem strategy. It is mistaking a temporary, cyclical headwind for the dominant, long-term structural story that is unfolding. The true economic value of these strategic investments will compound significantly over the next 5 years, not just the next 5 quarters. This analysis differs from the consensus by focusing on the fundamental, structural enhancement of the moat, which provides confidence in the company's ability to grow faster than the market currently expects for a longer period than is currently reflected in the stock price.
So the market sees a cyclical slowdown, but the second-level thinker sees a structural strengthening masked by that slowdown.
That's a great way to summarize it. Okay, to synthesize everything we've discussed into a concise overview, let's summarize the key points of both the bull and bear cases for Home Depot.
All right, let's start with the bull case. The reasons to own this company. It really boils down to 4 powerful points. First, Home Depot possesses an impenetrable and widening fortress. This dominant economic moat is built on that Lollapalooza effect we discussed, a confluence of unmatched scale, an iconic brand, and that rapidly expanding high switching cost ecosystem for the lucrative professional customer. Second, it's led by rational, owner-oriented stewards. The management team demonstrates a clear long-term philosophy and executes a disciplined, shareholder-friendly capital allocation strategy, consistently reinvesting intelligently to widen the moat while returning enormous amounts of cash to owners. Third, it's an enduring and intelligible business. The company operates a simple, understandable business model that's tethered to the perpetual human need for home repair and improvement, supported by durable, long-term structural tailwinds like an aging U.S. housing stock that constantly needs work. And fourth, it is a true financial powerhouse. The business is a cash-generating machine that produces exceptionally high returns on invested capital and converts accounting profits into free cash flow with remarkable efficiency, providing the financial firepower to simultaneously invest for growth and reward shareholders.
Sounds compelling. Now, on the flip side, the bear case, or the counter thesis, also has 4 compelling points that deserve close attention. First, there's a demanding valuation. The company's superior quality is very well recognized by the market, and its stock consistently trades at a premium valuation, offering little margin of safety at current levels and creating a tangible risk of multiple contraction should growth disappoint. Second, there are significant execution and integration risks. Persistent customer complaints regarding the execution of delivery and installation services pose a real threat to the brand's reputation, while the massive operational challenge of integrating the SRS and GMS acquisitions presents a non-trivial execution risk. Third, it has macroeconomic sensitivity. Business is inherently cyclical and exposed to the health of the housing market and broader consumer spending. The current environment of elevated interest rates continues to pressure demand for big-ticket renovation projects, creating a cyclical headwind. And finally, there's a potential for cultural erosion. There are signs of strain in the store-level employee culture, which, if left unaddressed, could weaken a key historical differentiator: the knowledgeable and helpful in-store associate, who often provides that essential in-person expertise.
Okay, so strong arguments on both sides. To really challenge our thinking, if we were to articulate the most compelling reason why an investment made today could become a major long-term mistake, what would that look like? Let's truly invert the bull case completely. How could this go really wrong for an investor buying now?
Right, the pre-mortem. The primary risk when you invert the bull case isn't that Home Depot will cease to be a good business. It's that an investor could fail by significantly overpaying for its widely acknowledged success at an inopportune point in the economic cycle. The most compelling argument for a long-term mistake is this. An investment today involves paying a premium price, specifically a PE ratio of approximately 25x, for a high-quality but fundamentally cyclical retailer at what could be the peak of market enthusiasm for its moat widening narrative. The entire bull thesis rests heavily on the flawless execution and integration of the SRS and GMS acquisitions and the continued dominance of the pro customer. This investment could become a major mistake if one or more of the following occur. First, the integration of SRS and GMS proves far more difficult, costly, and ultimately less synergistic than management anticipates. This could lead to prolonged operational disruptions, a failure to realize the promised growth from these investments, and potentially significant goodwill write-downs, which means they have to admit those acquisitions weren't worth what they paid, hurting their reported profits and balance sheet.
The acquisitions turn into an expensive headache.
Exactly. Second, the persistent negative scuttlebutt regarding the company's service quality, those thousands of complaints about delivery and installation, is not merely anecdotal noise. Instead, it turns out to be a leading indicator of deep-rooted operational dysfunction that ultimately alienates both DIY and pro customers, causing the trusted Home Depot brand to erode from the inside out, weakening that intangible asset they've spent decades building.
The service problems actually do start to matter to the core business.
Yes. And third, the new normal for interest rates remains structurally higher for longer, leading to not just a cyclical slowdown, but a decade of stagnant housing turnover and flat demand for large-scale projects. In this scenario, Home Depot's growth would effectively stall, and the business would begin to look more like a no-growth utility. An investor who paid 25x earnings for what becomes a no-growth business would face years of dead money or potentially significant capital loss as the market's lofty growth expectations are reset to a much more sober reality.
Paying a growth multiple for a utility business. Ouch.
Precisely. This inversion powerfully highlights that for Home Depot, the principal risk is one of valuation and timing, rather than the business fundamentally crumbling. The danger lies in effectively paying for a decade of flawless execution and growth up front, leaving no margin of safety for the inevitable cyclical downturns and operational challenges that even the very best companies inevitably face.
So what stands out to you from this deep dive into Home Depot? What's the one thing that really resonates after going through all this?
This exploration of Home Depot really brings home the idea that even for a dominant business with a really robust competitive moat, the price you pay and your understanding of the market's current expectations can be just as crucial as the underlying business quality itself. It raises an important question for all of us, I think. In a world where information is abundant and insights into great companies are readily available, how often do we mistake a clear trend for a guaranteed outcome, especially when the market has already factored in much of that optimism and opportunity into the current stock price? Something to ponder.